Okay, what is up, tycoons? What is up, traders? Super excited for today's video. We're going to talk about credit spreads versus debit spreads, and the key is to let volatility guide you. Okay, now I particularly love options trading, right? I'm in the Options Trading Tycoons Discord channel where pretty much all we do is trade options. It's very, very profitable if you know what you're doing, and you can lose all of your money if you have no idea what you're doing. So, hopefully, I can provide a little bit of guidance and clarity in today's video. Remember, none of this is to be considered financial advice, rather just free informational and educational content. Make sure to smash that like button and subscribe to the channel if you guys are new, and we're going to jump straight into it. Now, vertical spreads are among the first strategies that many option traders learn because they're relatively straightforward and typically have defined risk and return possibilities. There are two types of vertical spreads. There are credit option spreads and debit option spreads, but many traders struggle to choose one over the other. While the forecast for the underlying stock price is often the primary consideration, traders should not overlook the level and direction of implied volatility. All right, this is known as IV when deciding between these two spreads. So, deciding between credit spreads versus debit spreads, too high or too low. Traders often start by identifying the level of IV, which plays a crucial role in the pricing of options. When IV is relatively high, options tend to be expensive, and some traders prefer credit strategies to maximize the premium received. When IV is relatively low, option prices tend to be cheaper, and you guessed it, some traders prefer to buy options to minimize the cost, excluding transaction fees. Keep in mind, however, volatility can always go higher or lower. This is why it can be helpful to put volatility in the context of IV percentiles, which compares current IV to past highs and lows, typically in the 52-week range. IV levels for an underlying stock can be found on the Thinkorswim platform under the Analyze or Trade tab. Look at today's option statistics found below the option chain. There are several volatility stats listed here, and each has its benefits and uses. For now, we'll focus on IV and IV percentiles. As a general rule, some traders consider buying a debit spread when IV is between the 0 to 50th percentile of its 52-week range. That's because spreads tend to be less expensive when IV is low. Now, this video is not sponsored by Thinkorswim or TD Ameritrade or really anyone at all. There's no sponsors in today's video, but we are going to be highlighting the Thinkorswim platform. That is my preferred platform, and we're going to go ahead and highlight in a figure here, knowing the IV percentile, right? So if you look in this figure you can know the current IV percentile, and you can find the IV percentile of an option by selecting today's option statistics from the trade tab on Thinkorswim, right? And so you can look at the current IV percentile, the implied volatility right here, under that today's option statistics, right? And you can see when they are low or when they are high. It's very, very useful. Now, IV isn't necessarily cheap or expensive until you compare it to its own trading percentile range. Some traders prefer selling a credit spread when IV is greater than the 50th percentile of its 52-week range. The direction of volatility. This is very important. So let's talk about the direction of implied volatility. Direction matters because option trades are exposed to changes in IV, also known by its option Greek term vega. Okay, so if you're paying attention and monitoring the Greeks, you're going to be wanting to pay lots of attention to vega, all right, for the duration of the trade. Debit spreads typically have positive vega and benefit when IV rises over time. All else being equal, an increase in IV could provide the opportunity to sell the spread for more than the debit. By contrast, credit spreads typically have negative vega and benefit when IV falls over time. This makes sense because as IV falls, options become less expensive and are cheaper to buy back. However, because vertical spreads involve both long and short positions, some gains or losses from changes in IV in one contract will be likely offset by losses or gains from changes in IV of the other. The net vega of the spread can serve as a rough estimate to help understand how much IV will help or hurt the position, but other factors such as changes in the underlying stock price, how much time has passed, the bid-ask spread, and transaction fees will also affect the outcome of the trade. As another general rule, some traders prefer buying debit spreads when IV is low and rising, although there is no guarantee that IV will continue rising. Likewise, some traders prefer selling credit spreads when IV is high and falling. So in this figure right here on the Thinkorswim platform, we have the implied volatility indicator on here, and you can see that it's low and rising implied volatility here. All right. And then here we have high and falling implied volatility, right? So this is an area where maybe you would perhaps want to sell some credit spreads, right? And in this case, if you think the stock is going to go up, you would sell put credit spreads. And in this case right here, when you have low and rising implied volatility, you would be looking to make a purchase of a debit spread. And you could do that through puts, okay? But in this case, the stock actually went upwards and it was trading upwards in an upwards trend at this time. And we saw that the stock price also went up. So most likely you would be looking at some call debit spreads in this particular scenario. Now, this example chart with implied volatility moving higher as the underlying stock price trends lower, followed by a period of declining implied volatility as the underlying stock price trends higher. All right, so that's essentially what we're looking at right here. Now, when it comes to the bottom line, it's worth pointing out that there are countless ways to construct vertical spreads with various strike prices, expirations, and IV levels. A lot depends on a trader's forecast for the timing and movement of the underlying stock. Generally, traders often use debit spreads in anticipation of a move higher or lower in shares, and they tend to use credit spreads to collect premium. The bottom line, all else being equal, is that tracking the level and direction of IV can sometimes help traders decide between credit and debit spreads, as well as show how changes in volatility can influence the value of a spread. Now, I do have a scan, okay? I have a free video on YouTube for finding the best high volatility scan stocks. And it's really, really great for selling options in particular. Now, I go over how to set up that scan. We look at the implied volatility and the IV percentile, which both of those we highlighted in this video. If you're interested in selling options, I highly recommend watching that video. It's a really great one and you'll learn a lot, as well as be able to set up a dynamic scan that can update and alert you guys anytime a new stock meets your scan conditions. Appreciate you watching this video and making it this far. Make sure to like that, smash the like button and subscribe to the channel if you guys are new. Okay.